All right, guys, I'm here with Alden Armstrong. We've been having an amazing time so far, just diving into different companies, case studies. And today we're going to go through Case Study Alley, looking at nonprofits and how they can use life insurance and how they can potentially use life insurance even more, better than maybe some individuals. Alden, you're going to break that down. And I have to say, if you know people that are part of churches or nonprofits, send them this video, because if they understand the power of life insurance and they understand the power of being nonprofit status, put those two things together, I think it's very, very powerful. And without further ado, Alden, welcome to the show. And I've set the bar high, my friend. Don't hit your head on it.
Again, I'm always happy to talk to people. I'm really excited for this particular episode. I'm going to take you through some really, really fun and exciting things today. But first, I'm actually going to tell you about an unfortunate acquaintance of mine named Tamara. Tamara was born in 1988 on June 20th. And she is the child of the Internal Revenue Service and the U.S. Congress. With the birth of Tamara, the landscape of taxation of life insurance changed forever. And so we know about this term, modified endowment contract. That's where that came from. So we'll dive into that a little bit more. Effectively, before that date, life insurance policies could be funded with disproportionately large insurance premiums for 1, 4, 5 years. And there was no change to the tax benefits or the tax deferred nature of life insurance. At that time, life insurance, as we know, and we look at the Rockefellers, we look at a lot of the really, really wealthy families, they've been using life insurance for generations to carry wealth in between, but also creating millions of dollars of tax, billions, I would imagine, billions of dollars of tax deferred dollars that policy owners can get access to and use tax-free, and the IRS is not allowed to do anything about it. So to make a long story short, members of Congress and the IRS saw this as an unlawful tax structure, changed the tax law. And then in 1988, they passed a particular unfortunate bill that gave us the new definition of what was possible with life insurance. That new term is the modified endowment contract. And in a nutshell, this is the term that effectively can be defined as an insurance policy that has too much money going toward premiums, and that premiums are not buying enough death benefit. Now, according to Tamara, if a contract becomes a Mech at issue or at some point during the contract after 1988, all of a sudden, all of the profits in that insurance policy, if you go to borrow against it or take a distribution like a withdrawal from that policy, that's taxed at taxable income rates. Plus, if you're under the age of 60, you have a penalty tax. Very quickly, we don't want to get into Mech territory for the vast majority of our clients. This is where it gets interesting. Everything I just said is true, except for if you are a nonprofit. Why? Well, Internal Revenue Code section 501c3 talks about how nonprofits don't have to pay income tax. So this problem that was created by Tamara also created a potential very niche solution for certain policyholders, where we can put money away as a nonprofit, put money into these life insurance policies, deliberately Mech them for the high degree of cash value we have access to, and the nonprofit can use those dollars without any tax penalty. You saw a disclosure when you came on this video. Talk to your tax professional before you come talk to me. I'm going to show you how to do it from the insurance side. But again, I'm not taking on that liability. Go talk to a professional to make sure it makes sense for your situation.
Don't sue us. We're going to continue these educational videos. But what you're about to see is going to be incredible, because we're essentially able to give nonprofits and churches lots of liquidity, and within year 2, more money than what they've put in, and a significant death benefit that still gets paid income tax free to the nonprofit. And so it's like that, those two things, it's like, again, if people understand the concept of what we talk about on this channel and as a company, this should be very exciting when you start understanding, like, hey, what do the Rockefellers do? Keep money within their family, but then how can we do that for organizations that we love?
What I want to do for you to kind of start off the conversation here is I'm going to paint a bit of a word picture of the client that came to us looking for a solution. So Bob is the owner and the CEO of a nonprofit that he founded about a decade ago. He's 46. He's in good health. He's married. They're expecting their first child, and they each have whole life insurance and term insurance on themselves personally. He came to the table hearing about this idea that his business could own insurance. What I just described about what was possible with insurance, he had no idea. This is where I got interested and really started diving into what's possible. Now, the question becomes, if we're doing any kind of business planning, we have to have a good justification for the business to own insurance on anybody. Well, the nice thing is this is a business that does about $9 million of gross revenue a year. He, as the CEO, is a very, very integral piece of that company. So what we did is we're doing a key man insurance policy. The business owns a policy on him as an individual. The purpose and the justification to the insurance company is that if he passes, that death benefit's going to be needed to provide liquidity in a time of uncertainty, and then also allow them to bring in somebody else to take over and start running that company as a new CEO. So I'm going to pull up what we ultimately landed on. Now, as with anything, we worked with Bob. We worked with Bob here for quite a few months to figure out what exactly we're going to figure out and work best. This is one of the 3 solutions we came up with. And what I want you to notice is Bob and his company had a large degree of capital they were able and willing to deploy, $500,000. We built a policy that is this little asterisk, or what is that, the ampersand sign. That's perfect. This ampersand high, this ampersand sign is telling us that this is a modified endowment contract from year 1. Now, going back to our definition, that basically means we're putting in too much premium and buying too little death benefit in too short a period of time. So as you can see, $500,000 in premium equates to only $1 million of death benefit. Normally, that's a 4, 5, 6, or even more X factor. This is the number that my jaw kind of hit the floor when I saw it. Now, if we do some quick math, but I'm taking that cash value number and dividing it by the total premium put in the first year. The number that you get is a decimal, but it's a percentage, right? So it's 97 and over 0.25% of your premium is available to you at the end of the first year in net cash value. That's pretty insane, right? So it's a very, very high degree of liquidity. And what Caleb mentioned before, another fantastic opportunity, Bob here, he said, I wanted to fund this with about $1,000 a month moving forward. So we plan to do that every year. Now, I built in flexibility of this policy we're not going to go into necessarily, but he can put in more. That's just the maintenance premium that he wants to throw in there per month. What you'll see though, is year to year, he puts in 12. Look how much the cash value increases that year. He put in $12, he's getting $31, almost $32. What we've done by front loading the crap out of this policy is we've created a compounding machine where now, even if something crazy happened, and he can't afford $1,000 a month for some ridiculous reason, the annual dividend in this policy can pay for the policy for the rest of his life and still maintain that death benefit. As you can see on the right-hand side of the screen, there's no drop in cash value and there's no drop in death benefit.
The cash value grows significantly. The death benefit also grows. And this is like, if you were comparing this of like keeping your money in a high yield savings account or something, knocks that out of the park when you look long-term, and that a savings account doesn't include a death benefit component of this.
Yeah. Absolutely. Plus the tax savings, the tax efficiency, depending upon the state, this is in Tennessee, he's got unlimited protection for his business and the cash value in this policy. So a lot of really, again, talk to an attorney, a lot of really good, very good things from it.
Now, if this is a for-profit business, do you want to explain how Mech status affects this?
Yeah. So because of what was done in 1988 on June 20th, the infamous day, every life insurance policy that we sell at Better Wealth, if there's going to be a cash value focus and you want to use those dollars, we need to build a non-Mech policy, unless you're a nonprofit. And that's the niche that we're talking about right now. So whether it's a business or an individual, if you have a Mech policy, you accessing those dollars are going to trigger additional income tax, as well as possible fees from a early distribution penalty. The concept that we're using here to justify the insurance policy, that's key man insurance. We do that every day till we're blue in the face. It's very simple in most cases. This particular strategy, again, it's 501c3s. That's a nonprofit. And we've had Dan on the channel a couple of times from Foundation Launch. Shout out to Dan, great guy, helped me with my foundation as well. He and I have been talking about this idea of life insurance within a foundation. I'm gonna let him speak to that. That's a little bit more complicated. But in general, right, for most nonprofits, this can be a really good strategy. Well, we're going to look at actually 2 other policies I presented to Bob, and I'll kind of tell you which ones he went with and why. But to kind of recap what we're dealing with here, nonprofit doing a large amount of gross revenue has additional capital they want to deploy to be able to do the vehicle financing and the property purchasing they already do on a daily basis. So this policy and its cash values can be used for that purpose. Now, a question that I get a lot of, well, at least I got a lot from Bob, can I use these dollars for my personal needs? The answer is talk to your CPA. But in most cases, I'm going to say probably not. Now, the caveat to that is if the nonprofit has a profitable lending business where they're lending you money out of that policy, that could be fine. But there's certain regulations that I don't fully understand that you need to talk to a tax professional about to use that as your own dollars.
So an example is if you're running a church and church is sitting on money and they potentially want to buy a building or like use that money to potentially purchase vehicles or something for the church, and it's sitting in a savings account. What you could do is you could use the main pastor and put a life insurance on that, Mech the policy, still use the cash to do other things, and know that when that pastor passes away, the death benefit goes back into the church.
Back to the church. Exactly.
That's super interesting. I think we need to talk more about that because nonprofits should be doing this.
It's a fascinating strategy. I've had some fun conversations with a couple of different pastors about this strategy. Now, you have to understand that most churches don't have this kind of capital, right? But there are some churches who are very good at managing their finances. Not saying that some do and some don't. It's just life. I met with a gentleman. He's actually he's my real estate mentor who used to be a pastor in Columbine. To make a long story short, he talked to me about their financial situation as a church and as a church body. And they had hundreds and hundreds and hundreds of thousands of dollars sitting in multiple banks because there was a general distrust of the banking system, but they didn't know that this existed. If I had known then what I know now, it would have been a much different conversation.
Well, it's super interesting. I know a church right now in our hometown that is, in the process of buying land to build a building. And I think they have like over $9 million that they're sitting on to be able to deploy. And these are the kind of things that are like, can you imagine? Can you imagine if some of that got into that? They purchased the building, it had an outstanding loan, but were able to keep that. And then like the death benefit would be pretty massive. Like those are the kind of things that's, again, we're just speculating, but it's fun to think through these principles and figure out, because usually when you're in a nonprofit, you are thinking more long-term. Continue. I don't want to derail, but this stuff gets me excited as well.
This is why I got into insurance, because things are just fun when you start doing this kind of planning.
We need a t-shirt like that. It'll sell one of one. You'll be the only one that wears that t-shirt.
Amazing. I'd wear it every day. All right. So what I'm going to transition to now is, Bob and I had a really good conversation, and he asked me the question like, hey, does this policy have living benefits, and who gets access to those? The answer is yes. This particular insurance company we're looking at, Lafayette Life, they have an accelerated death benefit rider. And for those who've seen the channel, you know what that means. But effectively, you can pre-spend a portion of the death benefit while you're alive for certain qualifying medical expenses like a terminal or chronic illness. He asked the question about long-term care. That is completely separate. Anyone who's seen the One America video I did, they understand long-term care insurance is very, very different from any of these additional riders that we add. So I said, hey, we can do this same kind of strategy, but what if we look at a different company that actually can provide a true long-term care benefit? So what I'm pulling up now, Guardian Insurance, very similar design. As you can see that premiums didn't change. Got $500,000 in that first year. Goes to $1,000 a month starting that second year. All the way on the right-hand side, we still have about $478,000 of cash value at the end of the first year. Now, something to understand, because we're adding an additional benefit, we have an additional, we could say, hit to the cash value. But what did that hit do for us, right? So we went from about a 97% cash value. This brings it down closer to 95. We still have a high, and actually it's a higher death benefit in the early years. And then beyond that, what I'm going to show you is we've now purchased $361,000 of a long-term care insurance policy that allows Bob to be able to spend per month, if he needs to, about $14,000 a month for long-term care needs. Now, for a male, most long-term care claims are about 2.5 years. So this will cover him for the majority of that period of time. Now, something I want to point out here that we also pointed out in the last policy, high degree of cash value, very large dividend. That dividend is now, at the very second year, can pay for the base cost of insurance, including the long-term care insurance. So what this means is this could also be a set it and forget it policy where you just bought $380,000 or $360,000 worth of long-term care, a annually compounding line of credit through the insurance company as well, and a permanent death benefit. Whether you put $1,000 into the policy every month or not, you get a lot of benefits from a structure such as this.
It looks like there's a lot more death benefit on this policy. And then the long-term care, can you use the long-term care personally, even if a nonprofit owns the policy?
Yeah, because it's tied to the insured party, not to the owner of the policy.
Is that something that would be wise for people to talk with a CPA or their advisor about? Or is it pretty universal to say, like, it's one thing if you use the cash value for your own personal side, talk to someone about that before you do that, because the death benefit would go back to the nonprofit, correct?
Exactly. The death benefit would still go back to the nonprofit. Now, something you're going to have to clarify with your tax professional is, if we think about this, the long-term care benefit in a way is tied to the death benefit. And there's some things I could illustrate for you to kind of make that claim. So something that may be possible is if a long-term care claim is initiated by the insured party, that may affect the death benefit, may start drawing dollar for dollar down on the death benefit, because some long-term care whole life products are done like that. So if that's the case, that may be a taxable expense, whereas normally a long-term care draw is non-taxable. These are the questions I don't know because I'm not a tax professional, but I just think this is a lot of fun, and we came to a really good solution for what he was looking for.
And just to be clear, it could be taxable to the insured.
To the individual.
And you might be like, oh, that's not cool, which it might not be cool, but you're still getting a benefit. It's like, yeah, you got to pay taxes on the actual benefit that you're getting. And so there's a lot of different ways. Like we could get creative on how an individual could potentially use cash value personally and how the nonprofit could make that happen. We're going to do our best to not try to get into the weeds on this video. Just know that this is for educational purposes only. We're making you aware of something, and whether you reach out to someone like us, by the way, Alden and our amazing team is available to chat with you. And we've talked to many people that are interested in strategies like this and how to incorporate long-term care. And so we're available to talk to, or whether you talk to an individual that you trust that knows this stuff, it's important to make sure that your situation, you know, all the green lights, red lights, and the barriers on what you can and cannot do.
Yeah, and what we have to understand, most individuals who would fall into this category of having, one, a nonprofit, and two, the capital to throw into a life insurance policy, they likely have a trusted tax advisor. Like, no one out there is filing their own tax returns for a 501c3, I hope, right? So in this conversation, Bob went back, had conversations with his tax professional, and ultimately came to a decision of like, yes, this is the policy that we want to go with.
Cool.
So this is what we did. I'm going to show you actually a third policy that ties in another benefit that he decided against, but it's going to illustrate another product that we have access to that we can do some really cool things with. So this is another life insurance policy with Guardian. So this particular product actually came out last year. It's a very, very unique product in my opinion. It's the only one in the marketplace I'm aware of. It's called the Safeguard 360. So with that fancy name, you probably have the question of, okay, what's this 360 all about? What it's talking about is effectively this policy is providing three different kinds of benefit. We have the life insurance benefit, we have a long-term care insurance pool benefit, and we have a disability income benefit. So with the same insurance policy, what we're able to do is, again, we're going to $500,000 put into life insurance. We've gone, because we've added additional benefits, gone from about 97% cash value with the first company we looked at, Lafayette Life, to about 95 with the last policy. This is down to just over 90% of cash value in the first year. Annual premium, practically the same as well. And the difference is now, if you see the top of my screen, this can provide a disability income of $10,000 per month if he becomes no longer able to pay his premiums. Now, ultimately, we didn't decide to go forward with this policy. We had a conversation with the insurance company as well as the CPA, and there was not a universal consensus, shocker, that as the insured party, if he was disabled, can the premiums be waived?
Yeah,
because he's not paying the premiums.
Would you say this is more for a personal
yes.
decision that someone would make less of a, yeah.
Absolutely. So for a personal decision, this product can still be overfunded. There's still a lot of benefits, and you get kind of all three bundled into one. We presented this to him initially because he was asking for what extra benefits that we had. Now, through the course of our due diligence and his with the CPA, this didn't make sense for his particular situation. But I bring it up today to show that there's a lot of really cool things we can do. If you come to the table and say like, hey, I have an interest in X, Y, and Z, what can you do? Those are like my favorite things to hear as an insurance agent because I get to go shopping, right? I get to go figure out what's possible. And this particular policy, from an annual premium perspective, we get millions of dollars worth of death benefit. We have a long-term care benefit of $360,000 a year, and a payout that equates to about $14,000 per month if a long-term care need happens, plus disability income insurance of $10,000 a month, plus a waiver of premium. So there's a lot of things we can tie into this type of an insurance product. Now, as I said, Bob didn't go forward with this one. He went with the other one with a long-term care rider. But at the end of the day, the things that you bring into the call, the expertise that you're asking for in the specific areas that you want to see, that gets my team excited to go to the drawing board and figure out the best possible solution. Just a little backstory on myself. I came up as a career agent for one of the larger mutual insurance companies. What that means is I worked with one carrier with one product and I sold it like the best I could. There's a lot of benefit to that. I still sell that product, but now I'm a broker in the sense of the term, and we can work with many insurance companies to find the best solution because not every company gives you the best solution for what you're looking for.
Yeah,
and that's where we come in.
Yeah, and it's interesting. This policy, I know that it's a Mech, but it still breaks even in year 5, which is pretty remarkable. You get the $1.6 million death benefit, breaks even at year 5, gives you all those benefits, and yes, it's just interesting when you start seeing the pros and cons. It's like, yeah, I can see where this is attractive to certain type of person. And do you want to touch on why, even if you're not a nonprofit, if you're over the age 59, maybe in your 60s, 70s, where a Mech could be something to look into, because we talk about you pay taxes and could potentially pay fees if you're under 59 and a half, but you're paying that only on the interest that's earned. So it's like if you're putting in $500,000 and now it grows to 600,000, all the interest and potential fees, depending on how old you are, is only on the interest, not on the whole amount. And sometimes we're so anti-taxes. And again, I want to be very clear, like all of my policies are not Mechs. So it's not like I'm not like all of a sudden a huge Mech fan, but I think for a certain type of person, Mechs create an amazing like solution and blows CDs or potential fixed annuities out of the water when you look at the flexibility, the death benefit, and the growth rate that it gives you.
Absolutely. So I think to address the first question that you brought up is, when can a Mech make sense? We're actually going to be doing some more content around this in the future. I know you've done a little bit with Danny Ronberg. Shout out to Danny. High five. There's a lot of reasons to consider a Mech, but I'll say it's a very small pool of people. So for example, in the insurance space, the way I think about risk is risk ultimately needs to be transferred to somebody else. Why? Well, no single individual can handle all the risk of living too long, dying too early, not having enough income, all these different things. The whole concept of insurance is to pool that risk so that that entity can take care of the concerns that you have on the table. That's why insurance exists. And we're trying to consider a Mech. What does that do for us? Well, if I can make a contract with $1 and it gives me $2 of death benefit, that's immediate return on my dollars for my family. So that could be a consideration. Another thing we often see is we buy specific insurance policies that may or may not be Mechs for the purpose of the benefit that they provide. Whether that's just having access to safe capital, like a savings account, or it could be having access to the living benefits of the life insurance policy itself, which could be accelerated death benefit rider, long-term care insurance, just state protection to have the money there instead of a savings account. So what I'd say as a whole, we don't sell a whole lot of Mech policies because for a lot of people, they still don't make a whole lot of sense. But for the right person, it can. Yeah. And I'm not going to know that until I have a conversation with you.
Alden, any final takeaways from just this nonprofit Meching policy case studies? I know because we read all of your comments that you've been asking for more case studies. And so if you have video ideas or if you have questions, please include them in the comments below. And also, Alden, I see every video breaks down like the people that watch this that aren't subscribed. Half the people that watch our videos are not subscribed. So my ask to you is, if you've watched all the way to the end and this has been valuable to you, please subscribe. Please drop a comment. It like tells the YouTube algorithm that, hey, this is valuable. We're going to push this out to more people. And I just want to say thank you. You don't have to work with us at all, but if we can add value to you, please reach out. Subscribing, commenting, and liking really tells YouTube that they should share this video with more people.
I love that, Caleb. I'll add to that same type of ask. If there's something you want me to dive into, whether that's a topic, an illustration, a company in particular, everyone's been really, really great about throwing in ideas. Keep doing that. And I want to put a little bit of it's something exciting to look forward to. In the next 6 months, we're going to be doing some really exciting partnerships, looking at some really cool planning concepts that I think are going to blow the socks off a lot of people. So stay tuned, subscribe, get those notifications, and we'll see you on the other side.
I love it. And someone buy Alden a t-shirt, I love life insurance. Or let us know if we offered like a exclusive t-shirt, drop, I love life insurance, would you buy it? We might have to get like an exclusive 50 and see if we can get rid of them. Thank you, Alden.
Amazing. Awesome. Bye, guys.